Hi everyone, today's video is to help you understand what businesses have to record when they buy and they sell their products. Let's assume that our company buy and sell watermelons, shall we? Let's say we buy watermelons from a supplier that sells the watermelons to us for $2 each. So I'm gonna write it cost us $2 per watermelon. Now, and then we would turn around and sell the watermelons to people on the street for $8 each. So already you have two different prices. We buy low and sell high, which is what most companies do in order to make a profit. So let's say today we are buying 100 watermelons. So we buy 100 watermelons. That's gonna cost us 100 times 2, so $200. And to record this, let's say we bought it on credit. So when we have to record this, we need to use two accounts. One account is called merchandise inventory, or shorter name inventory. So I'm gonna write inventory. And since we pay, how did we pay? We didn't use cash, so we paid for it on credit. So we used the accounts payable. I'm gonna write AP, meaning accounts payable. So inventory is an asset, increases because we bought watermelons, we have more. So inventory is a debit of 200. Accounts payable as a liability also increased because now we owe more. It would increase on the credit side, so we would write $200 on the credit side for accounts payable. All right, so now we're gonna go and sell some watermelons. We put ourselves, and attract the crowd, and in one day we sold 20 watermelons. Sold 20 watermelons. Now, when we sell our products, we need to record two sets of journal entries. One set is for revenue, the other set is for expense. So what do I mean about that? Well, when you bought your watermelons, you already have two costs, right? One, the $2 each is what cost you. The $8 each is what you sold to the customers for. So we're gonna record first of all the revenue journal entry. So for the revenue is what we got from the customers because we made the sale, right? So we sold the 20 watermelons, 20 times $8. So we would receive $160. Now, if the customers paid us in cash, we would use cash. If the customers paid us on credit, we would use accounts receivable. So let's assume that this is one customer who bought 20 watermelons from us on credit with us. Now, this on credit is not with credit card. Credit card is something else. Credit card is considered cash. This on credit means from business to business. Usually, when they have done business to each other for a while, they build a trust. So they negotiate and no longer have to pay everything up front, and they give each other the option to pay later. That's the credit we're talking about. Okay, so since we made a sale, I'm gonna call it sale. Oops, sorry. So I'm gonna call it sales. And then the other account I use, because I did receive some kind of compensation, I would write down accounts receivable. Accounts receivable. So, well, how much, right? You probably ask. Well, you did sell to your customers for $160, and that's how much they owe you. So for sales is 160. Sales is a equity. It increases on the credit side, so I'm gonna write down 160 on the credit side. And accounts receivable as an asset, it would increase on the debit side, so 160 over here. All right, and so like I said, that this journal entry is to show you to record the revenue. All right, but we also need to another journal entry to record the expense. What is the expense? Well, when you sell your watermelons, you give away your watermelon. And as I've mentioned many times in this class, if you use anything, you will have an expense. So if you think about your products, the watermelons, it's like we used a watermelon, right? So the expense associated with selling products is called cost of goods sold. So I'm gonna write down the account cost of goods sold. And the other account I would use is inventory, because your inventory did reduce when you sell the 20 watermelons. You no longer have the watermelons. Now, how much? So you need to remember the expense is based on how much it costs you to buy the watermelons in the first place, which is $2 each. So right here, it costs us $2 for each watermelon. Therefore, my cost of goods sold have increased by 2 times 20, which is, so this one is 20 watermelons times $2, so $40. So cost of goods sold would increase, and on the debit side, 40, and the inventory will reduce on the credit side, so 40 for the inventory. All right, so now if we draw a T account for these, just as a summary, we purchased inventory. We purchased more watermelons earlier. We did purchase $200 of watermelons, and we owed $200 to our suppliers. And then we sold watermelons to customers. So we have sales and AR. The sales was 160. Accounts receivable is 160. Well, but we did give away our watermelons, so inventory reduced by 40, and we need a cost of goods sold of $40. So originally we bought $200 worth of watermelons. After selling $40 worth of it, we have $160 worth of watermelons left. And there you have it. That's how we record buying and selling our products.